Now, so we have call buy and call sell metrics. So buyer of the call option has the right to buy, no obligation to buy. He pays premium, he has limited loss, unlimited profit. Seller or the writer of the call option has obligation to sell, receive premium, unlimited loss, limited profit to the amount of premium he receives. Fine. Now, and if you think about the put, we'll explain put later on, but put has the right to sell, put buyer. Okay, no obligation to sell, pays premium, limited loss, unlimited profit. Same as call, but he has the right to sell. Okay, and put writer has obligation to buy, same as call seller, call writer, but here is the obligation to buy and they have the obligation to sell. See, we'll discuss, but little later on. Now, we have discussed about the in the money, out of the money concept. We are going to repeat it. Let's suppose the spot price of index, let's say S&P 500 is 5,000. Let's suppose. Okay. So if you are buying a call option at 5,000, okay. So that means the strike price is 5,000. Okay, that would be understood as the at the money call option. Okay, and if you're buying, a call option cheaper than the market price, so that would understood as the in the money option contract. Fine. So if you're buying cheaper than the market, that is in the money. If you're buying call option costlier than the market, that is out of the money. Now, if we look at carefully, the premium we have listed here, the premium is less for out of the money contract and a little higher for in the money contract. Okay, so in the money, as you go deeper in the money, you have higher premium. If you go deeper out of the money, you have a lesser premium. Okay, why this? Because premium is made out of two components. One is intrinsic value, another one is time value of money, TVM. I'm writing short form. And what is intrinsic value is the spot minus strike price in case of the call option, for call option. Now, so here, let's suppose for 4,900 strike price, what will be my intrinsic value? So spot is 5,000 and exercise is 4,900. So 100 is my intrinsic value. Okay, so if you're buying it cheaper, okay, how much cheaper? You're buying it 100 rupees cheaper. So that is the intrinsic value. If you are buying out of the money, then there is no intrinsic value because you are buying already costly. So you're buying 5,100 whereas the market is 5,000. So there will be no intrinsic value. Okay, because you're buying costly. Now, so what will be my time value of money? So I know the, premium. So time value of money, I can write it like this, minus the premium I know. So the premium is 130, which is already given. So time value is 30. Okay. So premium is made out of intrinsic value and time value. Here, your 130 is made out of 100 plus 30. That is 30 is time value and 100 is your intrinsic value. For a strike price of 4,900. Fine? Fine? Are we okay till now? Great. So, out of the money, as I said, does not have the intrinsic value because you're already buying costly. Now, one more thing. If you recall the future contract formula, spot into exponential to the r power t, simple. So we remember one thing, as the contract reaches its expiry, the time value keeps on reducing. So on the date of expiry, the future contract should be priced same as the spot. Otherwise, there will be an arbitrage. Okay. So here, same is with the call option. The interest rate charged on a contract keeps on reducing every day. Okay. So when option reaches its maturity, its expiry, there is no time value left. The time value become 0. Okay. Now, so let's understand this thing through a calculation. Let's suppose I'm buying a call option. Now with a strike price of 4,900 and I know the spot is 5,000 today. Let's say on 1st of January, and my premium I paid was 130, which is also given, let's suppose. So I put a minus sign here because when you buy a call you have to pay. So now when you buy a call, somebody is selling the call option. Right? At what a strike price? The same you bought? Obviously, when you are buying a contract at a given price, somebody is selling that. Now, also one more thing, when you are trading online, okay, so it's impossible that buyer will get, negotiation over the phone. So at different strike price, they create different contracts. Okay, so 5,000 strike price, it's a different contract than 4,900 strike price. So when you are buying a call at 4,900 strike price, so somebody is selling you that call. That's why you are buying it. So when somebody is selling, is receiving premium from you 130. I put a plus sign here. So what happens is, it's simple. When I'm buying a house, I decide the rate of 1 crore. I pay the premium and seller receives the premium. Same thing is here. 4,900 is my deal strike and I'm paying premium as a buyer and seller is receiving premium. Now, so let's suppose this was on 1st January. So let's suppose 28 January is my expiry date. Okay, maturity of the contract. So if I'm buying call, how will I close my position? By selling it. So what I do is I sell the call. Which call I will sell? The same strike price I bought to close that. So I'll sell this strike price 4,900. Fine. So when I sell a call, I receive premium. How much premium I will receive? That depends on the spot price of 28 January. So what is the spot price on 28th? So let's suppose the spot price on 28th goes to 5,100. So from 5,000 it increases to 5,100. Now how will you calculate the profit? You're going to calculate the profit from your purchase rate and the today's market rate, or previous spot rate and today's spot rate. Answer me this silly question. Profit will be calculated based on your contract price and today's spot price, or 1st January's spot price or today's spot price. Please write. Answer me. Today's price, spot, and previous day's spot or previous day's strike. The strike price or the spot price. On. Exactly. So your contract price, that means you are getting the underlying asset at your contract rate. And today's price is how much? 5,100. So that should be your basically the profit. So I have to calculate the premium. When I sell, I'll receive the premium. Now, premium is made out, as we know, intrinsic value and time value of money. Correct? Now, so what should be my time value on the date of expiry for this 4900 call? 0, as I told you. On the date of expiry, the time value will be 0, theoretically. And what will be my intrinsic value? Spot minus X strike. So spot is how much today? 5100. And at what price I bought? 4900. So my intrinsic value will be 200. So what will be my premium? Basically 200. So I gonna receive 200 here when I sell. So the difference is my profit. So what is my difference? Here 70. So this is my profit. Now look at from the prospect of the call seller. Now call seller has to close his position by buying the call, right? So which call he gonna buy? The same 4900 to close. So when he buy, he has to pay premium. How much premium he has to pay? Obviously 200, because the spot price is 5100 right now. So the premium he gonna pay is 200. No time value, only intrinsic value in the premium. So premium is 200. So what will be his loss? 70. So the seller is giving profit to the buyer. Now let's take one more example. Suppose, so I'll erase a little bit of ink here. You got it? What happens? What happens if the price, instead of increasing, it goes down? Oh, I've increased all the inks. I'll write it again. So spot 4900, buyer, sell, spot 4900, premium 130 paid, premium 130 received. Fine. So 1st January, 2nd January, sorry, 30th January. Now let's suppose instead of a spot increasing to 5100 on the date of expiry, it went down. It went down to 4800, let's suppose. It went down. Now the buyer of the call option has to sell his position to close. So he has to sell the call. Okay. So sell call. I'm sorry, it is not spot, call. I'm so sorry. It's a call. So you're gonna sell the call instead of buying. So which one? The same strike price. So what will be the premium here? Just check out. So premium should be intrinsic value plus time value. Time value we know is 0. Now tell me one thing. Currently this is spot. This call is 4900. So the strike price is 4900. And today on 31st of January or 28th of January, the spot price is 4800. So this is an out of the money call now on 30th, or in the money call. The call becomes in the money or out of the money on 28th. Your strike price is 4900, spot price is 4800. So call is costlier than the spot price, so it's out of the money or in the money on the date of 28th. This is the spot 4800. Out of the money. Correct. So out of the money has intrinsic value or no? No. Correct. So here if we put spot minus a strike, so spot is 4800 and spot strike is 4900, it will give you what, negative value. So intrinsic value cannot be negative, so it would be 0 only. So 0 plus 0 is 0. So basically when you are selling a call, you're gonna receive 0. So your entire loss will be 130, but you will not lose more than 130 in any case, even if the market goes to 4500. So your loss is limited to the amount of premium you paid if price falls. And you're gonna buy the call option to close the position in case of seller. So you're gonna receive how much premium you have gonna, as a buyer pay. Okay, so as a buyer you wanna pay is 0. So your total profit is 130. So here as a call seller you're gonna receive 0. Okay, so when you're receiving 0 paying 130, your loss is 130. And if you're buying a call to close your position, you're gonna receive the premium, which is 0. So you're gonna pay the premium as a buyer. So you're buying premium as a buyer, so you're paying 0. Previously you received 130, so your net profit is 130. Simple. So that is how the settlement is done. So when you are buying and when you are selling, that's how the settlement is being done. Okay, online. So when you buy, somebody is selling, you're paying the premium, somebody is receiving the premium, and you close the position by selling, so you receive the premium. If price goes up, you receive the intrinsic value. There is no time value on the date of expiry. But yes, if you exercise the option before, you have some time value, so you make some extra money. Okay, the time value also you get back. Okay, now, so here we understood the concept of moneyness, strike price, okay, spot price, premium, how the premium, what are the components inside a premium. Okay, so another simple way to calculate your profit is very quick. You can put a formula here. What? So you have to calculate the payoff first. Now payoff is not profit. Okay, so payoff of call option, you can simply write it like this: max of max of strike price minus, sorry, spot price minus exercise price. So this is the spot on the date of expiry, okay, or 0. So the payoff for call option, okay. So which means your payoff, it's not the profit. Now profit if you want to calculate, so that means payoff minus the premium you paid. So that is your profit. So here let's suppose you bought the 4900 call, and on the date of expiry, okay, the spot went to 5100. So in this case, max of spot minus strike. So spot was 5100 on the date of expiry, and the strike price was 4900, or the exercise was 4900, or 0. So in this situation, which is max? This one, this is 200. So 200 is your payoff for call, and what will be your profit? 200 minus the premium you paid, so 70 is your profit. And let's suppose the price goes down. If price goes down, let's suppose to 4800. Now the value goes negative, minus 100. So which is maximum? 0. So 0 will be your payoff. Okay, so your profit will be 0 minus premium, so 130. So 130 is your maximum loss. Okay, you got it? Or other way, if you understood the desi tarika, ठीक है, desi funda, simple. At what price you bought? I bought at 4900. Where the price went? 5100. So I got 200 minus how much I paid premium 130. So 70 is my simple profit. Another way, let's say the market went to 4800. Which price 14 I bought? 4900. Market is cheaper. I will not exercise. My maximum loss is 130. Simple. If price goes down lower than my strike price, I will buy from the market. I will not buy from the seller. Maximum loss is 130. So you can think like this also. So simple. Now, so I give you some questions to solve. Okay, we have a doubt here. We have a doubt from Garke. Yes, ma'am.
Hi, Praveen. I have a quick question here. So my question is, I mean, so far it was great, but one little question that I have is, so for call options, if the current market price is greater, right, um, than say 5,000, which is my contract price. So if the price is market price is more, then it's in the money, right? I think it says out of the money. But if the market price is greater than my contract price, then I'm in the money, isn't it?
See, if market price is more than your contract, okay, then it is
Mm-hmm.
obviously in the money.
Right, for a call option.
Yes.
Yeah, yeah, okay, okay.
So that is what we are discussing here. Basically, if you are buying a call option which is cheaper than the market price, so this is in the money. Or a vice versa, you can say that if the spot price is higher than the strike price, then stay in the money.
Oh, right, right. I was reading it the wrong way. Okay, got it. Thank you.
Fine. So we'll take some question. Okay. Simple questions. See, my objective is that you understand the concept very well. If you understand the concept, it remains with you. And when you are reading a textbook or you're going through a lecture note, either if you're following a GAP material or any other material, let's say you're taking. So if you're going through those things, you would be able to understand. What happens is, let's say I'm teaching you 3 months before the exam. Quite possible you may retain it, quite possible you may not retain it. You are creating your notes. When you're creating your notes, you recall those things. Okay, so you have video tutorials for your help in your accounts. You can revise those video tutorials. But if you understand the concept, if there are 5 concepts more attached to it, so you're easily able to solve it. So the foundation has to be very strong. Now, so I give you a simple question. Let's suppose I am buying at a strike price. Now just forget about this. Now I am buying today's spot price for something is 8,000. Let's suppose it is Nifty index, a Standard and Poor Nifty in India. And the strike price or the exercise price, okay, both are the same thing. If it is, suppose 8,100. So you're buying out of the money. The premium you paid is 50. Okay, premium you paid is 50. So this is what on 1st January. So I have a question. What if on the date of expiry, spot goes to 8,200? What will be your profit? Condition 2, if a spot goes to 8,000, what will be your profit or loss? Or if the spot goes to 7,900, what will be my profit or loss? In all 3 conditions, calculate and tell me. So when we initiated the contract, the spot was 8,000. But we went into a contract for a price of 8,100. And the premium we paid was 50 rupees. So suppose we are buying a call European. I'll explain about European and American, but understand. So I got answer from Avik. He's very quick. So I'm waiting for answers from. So Jadip is telling me 50 each. Avik is telling me 50 each. Any other opinion? So I got answer from Avik, Jadip, Nitin, Avik. Fine. So first one is 150-50. Krishna Chandra. Okay. Wrong, Krishna. See, let's solve it. It's simple. We bought at 8,100. Extra strike price was 8,100. Forget about this. Forget about what was on January. So we bought at 8,100. The strike price was 8,100. Fine. So on the date of expiry, what was the spot? So spot minus the strike. So spot was 8,200. Strike was 8,100. So I gonna get a payoff of 100. Okay. Minus the premium I paid. I'm sorry, I should put a sign of minus here. So minus the premium I paid. So my profit is 50. Okay. In second case, uh, in second case, uh, so in second case, market went to 8,000, and I went to my strike price is 8,100. So it is cheaper. I will not execute. So zero is what I'll gonna get, and my loss is premium. And in second case also, market went to 7,900, lower than my strike price. So I will not execute. So my loss will be 50, which I paid. Okay, good, very good. So everybody was almost correct. Now let's take another example question. So let's suppose the spot was 8,000. I buy a call European for 7,900, and I paid a premium of 150. Fine. So I took it like this, the strike price. And at the same time, I also, this is buy, so I'm selling a call European at a strike price of 8,200. Keep it 8,100, and the premium I received was, let's suppose, 100. Fine. So I took two positions. I buy a call at 7,900. On the same date, at the same time, I'm selling a call at 8,100 strike price and receiving a premium of 100. Now tell me, if condition is market remains 8,000, market goes to 8,100, and if market goes to 7,900, all three, the spot on the date of expiry. So there are three conditions. Tell me, in first, second, and third condition, what will be my net profit or loss from call buying and call selling? Okay, these two positions. So we got first answer from Krishna, very fast, very good. A week. Second. Okay. Jaydeep, 50, 100 minus 50, 150. Okay. Okay, Jaydeep, okay. In second condition, total loss of 50. Okay. Shall I solve? Okay, let's try. Simple. You did pretty well. Many were correct. So in condition one, so the market went to 8,000. So we bought call at 7,900. Market went 8,000. I'm getting 100 and minus 150. So in first case, I'm getting here a loss of 50. But at the same time, I'm selling a call at 8,100. So my call is above, you know, more than the spot price. And when I'm selling a call, I am basically bearish. Fine. So I am bearish and market is below. So obviously I'll have some intrinsic value here. Okay. Perfectly fine. But tell me one thing. I'm buying at 8,100. Market went, I'm selling at 8,100. Market went below 8,000. So the call buyer will not come and execute. Okay. So call buyer will not come and execute. In that situation, from selling a call, I will have a profit of 100. So in first case, I'm making a profit of 50. Fine. So here 7,900 call, market went to 8,000. So I gonna receive intrinsic value of 100 and as a premium. And the premium I paid was 150. So 150 was lost from, sorry, 50 was lost from call buying, and I gonna get 100 as a premium because price went down to 8,000. So my total net profit will be around 50. So my profit would be around 50. In second case, okay, the market went to 8,100. So the from 7,900 strike price, market went to 800. So I'm gonna receive 200 here, and I paid 150 as a premium. It was the cost. So I have 50 in my pocket. And call selling market remained closed at the same point. Okay, so 100 rupees will be in my pocket entirely, because if call buyer executes, okay, he'll get 0 as intrinsic value and 0 as time value. So you're gonna receive 0 as a premium. So this 100 entire is into my pocket only. So if market closes, even at the money, at the time of expiry, at the money, contract will have 0 intrinsic value and 0 time value. So what happens is the entire 100 rupee remains with the seller. So in second case, we'll make a profit of 150. In third case, market went down. So the 7,900, so entire 150 is gone, the premium, call buyer. and you're going to receive a premium from call seller. This profit is entire your profit. So here your loss is 50. Fine. So 50 in first case profit, in third case 50 loss, second case 150 profit. Are we okay with this thing? Any confusion? No. See, what happens is when we are selling a call, okay, let's say if we are selling a call, yes, there is no obligation from buyer side. So what happens if the market goes down to 8,000? Buyer will not buy at 8,100 from you. So he will leave the premium with you. So the entire 100 is yours. Okay. And if you put the formula also, just check out the max of spot minus a strike or zero. So here the spot price was 8,000 and the strike price was 8,100. So here that value will be negative. So negative will cannot be the intrinsic value. The premium will be payoff will be zero. And what will be your net profit? Obviously this thing 100 and 0. So basically 100 remains in your pocket. So in first case what happens is the buyer side we have a loss of 50. Why? Because you are buying at 7,900 and market went to 8,000. So these are two different contracts. The same guy, let's say, okay, so what happens is, let's say a week on 1st January decides to buy two calls, and decides to get into two positions. One is a call buy with a strike process 7,900. On the same day, he chooses another contract of 8,100. He sells that. So now he has two positions with him. Okay. So then you have to calculate profit from 7,900 and 8,000. The difference is 100. And 150 you paid. So 50 is your loss. And here 100 is saving. So what plus 50 you are making. So you got it, Avik? Confusion is done. Great. Now, so let's take one more example. Now, this example I'm going to give you from option strategies. Okay. So this is called a covered call. We have not yet come to put, but we are taking a covered call strategy. So what we do here is we buy shares. So we're buying shares, let's say, for $200 or 200 rupees each. And at the same time, we are writing a call, okay, at a strike price of 210. So this call, when you're selling, obviously will give you a premium, let's say of 4 rupees. So the premium you are receiving is 4 rupees. Right? Now, what I'm actually thinking here is, I know one thing, that the current share in near term will go up. It will go up, but it will not go beyond 210. So from 210 it will come down. How I can say that? Let's say I have taken a monthly standard deviation, which is almost 5-7%, okay, in a month. So I concluded that a 5% is 210, so it will not go above 210. Or let's say I know technical analysis, so I know the levels, support and resistance levels. So I know there's 210, there is a resistance, so price will not go above this level. So what I do is I sell a call at 210 and receive a premium of 4. Now in this situation, what will happen if on the date of expiry exercise the spot price goes to, as we thought, it goes to 208, and let's say in condition 1, condition 2, if the spot price goes to remains let's say 200, and condition 3, if spot goes to 220, and condition 4, if a spot goes to 190. So answer me for these things. The spot means the share price. Share price is basically the spot price, the underlying asset. So I'm holding underlying assets and I'm selling call this time. So I'm buying this shares, keeping in my demat account, and selling call at 210. So shares will obviously give me profit if price goes up, and if price goes down, shares will give me loss. And call, obviously, if price goes down, it gives me profit but limited, and price goes up, it gives me loss unlimited. So what will happen if price goes to 208, 200, 220 and 190? In first, second, third and fourth case. So let's go back to the put option. Put option has told you the right to sell, no obligation to sell, pays premium, limited loss, unlimited profit. And put buyer has the obligation to buy. It's opposite. Okay. ठीक है. So let's suppose, when do we take put? I want to sell my house because prices are falling in the market. Fine. So what will I do? I look for a buyer. This time he approaches. Buyer says, yes, I'm interested in buying your house. So seller says, I want to sell it for $1 million. And the seller says also that I can give you delivery only after 1 year. So my expiry date is, so the maturity is after 1 year. But also I'm not sure that I'm gonna guarantee you the delivery. Why? Suppose I want to sell this house because I want to go to America to live with my daughter there. So I'm gonna live with my daughter and I'll sell this house. But I'm not sure if my mood changes. So that's why I want to have the right to sell, but no obligation to sell. Now, this is an excuse, but actual what is going in the mind? The prices are falling right now. So let's find a buyer. Sell right now. If price falls in future, I'll sell. If file does not, if price does not fall in future, I will not sell. So he says, okay, then why should I pay now? He said, no, 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 you don't have to pay me today. I'll give you something. So he says the buyer, uh, see, you are not taking obligations to deliver. Why should I take the risk? Right? He's very much right. The buyer is telling you that, okay, fine, you're selling your house to me. I'm ready to buy, but you are telling me you will give after delivery after 1 year, and that is also not guaranteed. So why should I take? What is my benefit of waiting so much for you? I'll buy from somebody else. Then the seller says, dear, I'll give you 100,000 as a premium. You keep it as a token. If price increases in future, it will give a cushion to you. Okay. And if you don't deliver it, you keep the premium. So they agree. So here the strike price was 1 million. The premium was 0.1 million. So 1.1 million was total cost, break even. So after 1 year, let's say price goes to 1.2 million. So buyer thinks price have increased, but I have to pay $1 million to buy. So I have already got 0.1 million as premium, 100,000. So if I buy, she's a buyer, if I buy at 1 million, my profit will be 0.3 million because market price is 1.2 million. I gonna get it at 1 million and zero point 0.1 million I have already got it. So from market I'll get it 0.2 million and 1.1 million I already have. So total profit was 0.3 million. Whereas he goes to the friend, he says, would you sell your house now? Now the friend says, I'm not a fool. If I sell, I'll face a loss of 0.3 million. And if I don't exercise my contract, maximum you're gonna keep it what? 0.1, the premium I paid. So he'll deny. So if price falls, he will sell. If price goes up, the seller will not. So let's take condition 2. Price goes to 0.8. He says price have decreased, but I have to pay 1 million to buy because it is obligation. So I've already got 0.1 million as premium, but if I buy at 1 million, my loss will be around 0.1 million. Why? So price is 0.8. So friend, I want to sell my house to you. Let's exercise our contract. Give me $1 million. He will exercise. So buyer will face loss. So buyer says, I don't want to buy. But then the seller will say, you took 0.1 million as a premium. So it's your obligation to buy when I sell you. Okay, fine. Says to take. So in case of a put, the payoff will be like this. Okay. So what is here? If price decreases, reduces. So the buyer of the put option will have unlimited profit. Not unlimited, till zero. Okay. So maximum profit will be the strike price. So if selling at 8100 and price goes to zero, so entire 8100 will become the intrinsic value. Okay. And if price increases, he will not execute the option. In that situation, what will be his loss? Here it is written wrong, 1.1. So if price increases, his loss will be maximum limited to the amount of premium he paid. And if price goes down, he will exercise and he will make unlimited profit. Fine. Whereas if price for the seller, put seller, because he is bullish, price goes up, increases 1.1, 1.2, 1.3. So what will happen is, one is his strike price. If price reduces, he will have a break even at 0.9, but below that it's his loss. And if price increases 1.1, 1.2, 1.3, 1.4, 1.5, whatever, he'll have a profit. But how much? The premium he received, because the seller will not sell. To the put seller, basically he is into a long position, he'll receive the premium. So the put buyer, who is actually a seller, so put buyer will not exercise his option. So he will not sell the property. In that situation, the premium received by put writer or the seller will be his maximum profit. Right? Now, understand the moneyness concept here. Here, little it's opposite. So if you are selling your property, that means you are buying a put higher than the market price. If the spot price is 5,000 and you are buying costlier, you are buying a put option costlier than the market price. That means you are selling something costlier, so it will have intrinsic value. Okay, and if you are buying put cheaper than the market price, that means you are want to sell underlying asset cheaper than the market price. So basically you are selling at little loss. So this is out of the money. So remember, it's easy to remember. So you are buying a put cheaper than the market spot, cheaper than the spot. It's out of the money. You are buying a put costlier than the spot. It's in the money, right? So here, if you write in the money out of the money, we can say that if the strike price is greater than the spot, it is in the money. If a strike price is less than the spot, it is out of the money. And the same it is at the money for put also. You can write it like this also. If the spot is less than the strike or the spot is greater than the strike. Okay, OTM. Fine. So this is for put. Now, so how will you drive the payoff formula for put? Put payoff, simple. Max of exercise price or the strike price minus a spot into or the zero. So this will be the payoff. Fine. So here, if we say if you are buying a put costlier than the market price, the strike price is higher than the spot price, so it will have intrinsic value and time value. So let's take example of 5200. His 250 is the premium. So spot price is 5,000. So what will be your intrinsic value? In premium, 200 will be your intrinsic value and 55 will be your time value. So you are selling something costlier than the spot price. When you are buying a put, that means you are promising to sell, but no obligation to sell. You're going to get into a contract. So you're selling 200 costless, so 200 is your intrinsic value and remaining is time value. Okay. So you have to remember one thing. Whenever you solve these questions, remember how you have to remember is basically when you are taking call, you're buying call, you're selling call, and you are buying put and selling put. You have to only remember one thing. Buying call means you are thinking market, you are basically into a long position. You think the market will go up. Okay. So it's not long call, long short. I'm telling you just thinking about positions. Positions when you are long, when you think the market is bullish. So I can write it like this also. Bullish, you are bearish. Here you are bearish and here you are bullish. Right? So if you think market will go up, two positions you can take. So if you think price will go up in future, so you can take two position. One, call buy. Two, put, sell. And if you think the market will go down or the price will go down, what you're gonna do is you can take put, buy and call, sell. Isn't it? Is But when you are buying a put, you have unlimited profit, limited loss. When you are selling a put, you have limited profit, unlimited loss. So this thing you have to keep in mind. Right? Now, it's 10:10. Let's take a break of 15 minutes maximum, and then we will start with option strategies. Okay? In your notes. Now, the first strategy is a protective put. So we're going to use the protective put strategy. So in this strategy, normally what do we do is we actually buy a put option, okay, with an underlying stock. Okay, so what will happen? It will create a hedge. So if the price goes up, your stock gives you profit and put gives you limited loss. So upside you have unlimited profit. And if price goes down, your stock gives you loss, but buying put will give you limited profit. Now, so before I go to protective put strategy, I think I should ask you some questions related to put, and then we will move on to protective put. Then it will be better because I don't know right now you are clear with put or not. So let's suppose the spot price in the market is 8,000 and I'm buying a put, European let's say, at an exercise price of 8,100, so which is basically in the money. So I gonna, let's say, pay a premium of, let's say, 150. So let's suppose if the spot price on expiry goes to 7,900, what will be my profit? And if the spot price on expiry goes to 8,200, what will be my profit or loss? Can you tell me? So I'm buying a put at 8,100. Basically, buying put means you are thinking the market will go down. So you're basically a seller. When price goes down, you make money. Okay. So when you are buying a put, that means you're thinking the price will go down. So if price goes to 7,900 spot price, and if price goes to 8,200, so when you bought it was 8,000. So what will be your profit or loss? So we have uh, when price goes down, we basically make profit. Okay, and if price goes up, we make lose money with put. So in first case, the price went to 7900. So you're gonna receive an intrinsic value of 200, and 150 is your basically premium which you gave. So in first case, your profit would be around 50, and in second case, when price went up, your loss will be around 150, because you will not execute the put option, you will not sell to the guy who made a contract with you. Instead, you will sell it into the market. So in that situation, what will happen is your maximum loss is 150 in second case. Fine. So let's suppose with the same example, I put one more condition. Let's suppose, not same example, I'll give you another question. So let's suppose uh, you think that the Nifty index will remain in between anything between 7200 is the low and 7800. Okay, so this is what is your assumption. So what you do is you sell a call at 7800 strike price, and you sell a put at 7200 strike price. Now tell me, what will be my profit if market is at 7300, 7400, 7500? So whereas the premium received with call was 5 and premium received with put was around 6. So what will be my profit if market closes at the expiry at 7300? So this is the expiry, or this should be the expiry, or this is the expiry. The spot price on expiry is 7500, 7400, or 7300. What will be my profit in all three cases? So these seems to be very late today, I guess. I'm not sure, I just noticed you just right now. Everybody is wrong here. You're selling a call, you're selling a put. At 7800, selling a call, and 7200 selling a put. Think again. Selling a put means when the price goes up, you make money. Selling a call means when price goes down, you make money. limited profit, both the cases. So I told you a practical case. Let's say the Nifty is at around 7200. That is with the chart, technical analysis. And the lowest support currently is 7200, let's suppose, and the highest resistance could be 7800. So I think it will not go above 7800, so I'm selling a call at 7800. And I know that it will not go below 7200, so I'm selling a put of 7200. Now, if the market closes 7300 or 7400 or 7500, in all three cases, what will be my profit or loss? Wrong, Gargi. Awake. Correct. So this could be a guaranteed formula to give you profit if you guess the levels perfectly. You take little extra range. It can give you something guaranteed. So this strategy will give you 11 profit in any case. Wherever the price remains in between 7800 to 7200 or 7200 to 7800, it will give you 11 rupee profit in any case. Let's just think, if price goes to 7300, what will put will give you? So it's above 7200. So if it is above 7200, put sell means we are bullish. So that means plus 6. That is my maximum profit. Call buyer, the put buyer will not exercise if rate increases, because put buyer thinks the price will go down, and price increases, that means the entire premium is with put seller. So 6 is put seller's premium. And you sold call at 7800, whereas the market went at 7300. So selling call means short, basically you are a bearish, so premium is yours, so 11. If it goes at 7400, obviously selling put, condition 2, you 6 you get, and 5 you get here, because it's still below 7800, 7400. So 11 is your profit. So wherever it goes in between 7200 to 7800, in fact it remains at 7200 or 7800, you make a profit of 11. Beyond these levels, you will lose. Okay, again please, fine, Jadip, I said if you are selling a call at 7800, that means you are bearish. Price will go down, you'll make money, right? So price went down to 7300. So in that situation, your profit will be limited to the amount of premium you receive, because when you are selling 7800, call buyer buys at 7800, it pays you 5 rupees premium. Call buyer will execute only when the price goes to 7900 or 8000 above. So will not execute. Premium is yours. At the same time, you have also sold a put at 7200. Selling put means you are bullish. Remember the matrix? You think the price will go up? So price goes up 7300. But what will be your profit? Maximum to the amount of premium received. So 6 plus 5, 11. So wherever it between, you have a guaranteed profit. Now I'm gonna tell you a technique. This is not in your book, FRM book. It's not there in curriculum. But I'm gonna tell you a technique This can give you almost 10 times return to maybe 100 times return in a day using options. Okay, you got it, this one? Fine, so everybody got this. So now I will teach you a technique. This is not in your curriculum, but that will give you maybe a profit of 5-10 times in a day, 200 times a day. Now, when we are trading options, normally, let's take example of Nifty. Now, Nifty has a daily volatility or standard deviation, daily standard deviation of around 1%. Okay, 1 to 2%. So I keep it 1%. That is around Nifty is 8,000. So the daily volatility minus plus would be around 80 plus average return. So could be 100 rupees or 100 point change daily. So daily change is around 100 points. So 81, 100 or 79 up and down. So I do a good technical analysis and I know that the price may go up today. And today is expiry. Fine. So expiry, the options are being traded. So it's expiry and I buy an out of the money call in the morning. So I take an OTM call in the morning at an exercise price of 8050. So we have a gap of 50 points for every each strike price, not 100 rupees. So I'm buying 8050 call. Fine. So this is an out of the money call. 50 rupees out of the money. Quite possible. Let's say the Nifty might be trading near 8040 and the spot price is 80540 of Nifty index and I'm buying 8050. That is an out of the money call. So when it is out of the money call on the date of expiry, my time value will, intrinsic value will be 0. It's out of the money, right? So out of the money call is intrinsic value, nothing but time value is there. But on the date of expiry itself, the last day of trading, so the time value will be also 0 theoretically. But in actual, the time value is there, maybe 10 paisa or 20 paisa. So let's suppose the time value is 20 paisa for that call, this call. Okay. Now, when we buy a call, we buy normally in lots. So when we buy derivatives, we understand that when we buy derivatives, futures are in lots, contracts. So these calls are also in lot sizes. Let's suppose the lot size is of 50 contracts. So per call is priced 20 paisa and the lot size is 50. So how much it will cost me to get one lot? How much rupee to buy one lot? Around 10. So if I pay 10, I get a lot of option contract. So I pay rupees 10 to get one lot of option contract. Now, so suppose the capital I have is 10,000 to invest, or I keep it 2,000 or 5,000. I keep it 5,000. So I'm investing 5,000, and for per lot I have to pay rupees 10. So for 10 rupees I got one lot. So how many lot I'll get here? 500 lots. So for an investment of 5,000 rupee, so I buy 500 lot. Why? Because one lot is priced 10 and one lot has 50 shares or 50 call options and one call option is priced 20 paisa. Now, so I buy it 8050 and when I bought it, it was, let's say, 10 a.m. and market remains still 3:30. By 1 p.m. I see the market jumped. It went up. There was some good news, and as I know that there is a volatility of 100 daily, it went around 60 point up. Let's suppose just 60 points up. I'm not giving 100, even 60 points up. So this is spot now becomes 60 points up. That means 8100. So from 8040, it increased in one single day, let's say till 1 p.m., just 60 points. So which means around a half percent, more than half, 0.75 kind of percent increase. So if it goes to 8100, then your call which you purchased at 8050, it becomes in the money. Previously it was out of the money, so now it becomes in the money. So there will be, for the premium, there will be still no time value of money. It was 20 paisa earlier. Let's consider it as nothing. It is gone till 1 p.m. But you have intrinsic value. Why? Because the call strike price is 8050 and the spot increases to 8100. So the premium will be around 50. Maybe because of the demand supply, it does not remains 50. Because of the delta, it may remains 40 only, but it will be there around 40, 50. So let's consider, I'm just teaching you a theoretical concept. In practical also we do it, but it's not 50, we get 30, we get 40, the premium. So I get 50 as intrinsic values there. So that is for per call. The premium is 50. So if I sell it, I'll get a profit of 50 minus the premium I paid, that was 20 paisa, 49.80 paisa per call. So how many lots I have? 500 lots. In one lot, how many calls? 50 calls. And per call, how much profit I made? 49.80 after deducting the premium cost. This will be my profit. And how much is this? I invested how much? 5,000. So let's calculate it. I'm using a calculator. 500 lot size, 500 lots into lot size is 50 into my profit 49.80, which comes to 1237500. Woo! 5,000 became around 1.2 million. And what is your maximum loss? If price is below 50. So that means if price is below 50, that means anything could be, let's say 8,000. So my maximum loss is the premium I paid. And I paid how much? 20 paisa for one. For 500 lots, I paid 5,000. So all 500 lots will become zero. That means my 5,000 is gone. So my maximum loss is 5,000 and my profit 12 lakh in one trading day. Quite possible. We have done it. Not 50 times, this much, but yes, 10 to 30 times, 40 times we made it. Hmm. So, did you get it? In beer call spread, what do we do is, uh, so we gonna buy at a higher strike price. So let's say higher strike price would be 50 and we're selling at a lower strike price, let's say 40. So the premium we paid was, let's say, 1 here, and the premium we receive here is $3 here. Now what happens if the spot remains 45? Not going up, it should go down. Let's say spot goes down. Let's say we can keep it little down also. So if the price goes down to 35, now what will happen in this case? The buy call will give you a maximum loss of 1 and the sell put will give you a profit of 3. So your profit will be 2, isn't it? So if the price goes down below 40, it gives you profit. So if you are bearish, what you do is you buy a call of little higher price and you sell a call of little lower strike price. You get more premium, more than the premium you paid. So the difference between premium paid and premium received is more, and the price goes down. The difference is your profit. Okay, so this is bear call spread. Now, same wise, you can do the same thing bear call spread using a put also. Now, so how you can do it is the put is, let's suppose an investor sell a put. So what you do is you look for a put with a lower strike price. So let's suppose so I keep it the strike price. Hold on. So strike price I keep it is 20 and the premium for the lower put which actually I'm selling. So I should better write it in a different way. Sell, keep it clear. Bear. So you can make a note of it. Bear put spread. The strategy is bear put spread. So in bear put spread, what do we do is if you have problem, listening, please let me know. So bear put spread. So what we do is we sell a put option with a lower strike price. Okay, and what do we do at the same time is that we buy a put option with a higher strike price. Okay, so basically it's put. Fine. So let's suppose the exercise price for lower put is 20 and exercise price for higher put is, let's suppose, 40, and the premium we paid was around, for a lower one we paid a premium of around 3 and for a higher one we paid a premium of around, let's suppose, 5. Okay, higher the put, it is more in the money. Lower the put, it is more out of the money. Maybe it can go out of the money. And let's suppose because we are taking a bear put spread, so that means we're thinking the market will be bearish. So let's suppose it remains below the higher put. So it is around 35. Okay, but more than this lower level. So the spot goes to 35. In that case, what will be my profit? So this put 40 strike price put will give me a profit of 5. But at the same time, I paid a premium of 5. And but I'm gonna receive 3 as a premium. So what will be my profit? 3. So if the price goes down, it gives you profit. And if price goes up, what will happen is above this level you have a loss. You have a loss of 2 because you are paying more premium and receiving lesser premium. So if price go anything below 40, let's say it goes below 40, it goes to 30, or let's say it goes to 25. In that situation, it goes to 25, then you receive 15. and you pay premium from put 5 and you receive premium from lower put is 3, so you have more profit. So this is a bear put spread. Now let's go for a butterfly. That's another strategy. Butterfly. Now why do we call it butterfly? Because the payoff chart looks like a butterfly, like this. Now, so in this strategy, what do we do is very simple. Uh, we take a upper and a lower call and we sell two calls in between. Okay, so the premium received is good. Now let's take example. Let's say what we do is we take a lower call and we take a call in middle and we take a higher call. So in call in between we take middle call, we take 2. So let's suppose the call we took, the lower call, the premium we paid was 6 and the middle call we gonna sell it. So let's say the mid call is for 2, we sell it, and another call, the higher call we gonna buy, that is for, let's say, the premium we paid was around 1. Okay, so this is could be done, or let's say the middle one is for 4 and the higher one is for 2, the premium, and the strike prices are, let's suppose, lower is 55, middle is 60 and higher is 65. One more thing, as I said, you have to take two uh, call in the middle, so you're gonna sell two call in between, and you're gonna buy two calls, one is a lower one and one is a higher one, to create a butterfly. Now let's see what happens is this butterfly says beyond the point, okay, you will have limited loss if it goes up or it goes down, and if it remains in between somewhere, you will have a profit, and the maximum profit is at the strike price if the market closes at the strike price of the middle call, the call you bought at the middle price. Okay, so at this position you will have the maximum profit, and remaining above and lower you will have losses that would be limited. Now let's check out what will be the payoff if, or the profit, if we remain at 60. So let's suppose the spot goes to 60. Now the lower call will give me a profit, so lower call will give me a profit from 50 went to 65, so it give me 5, but it also is giving me a loss of premium. Then the middle call, so this is one is the lower call, and then let's look for the middle call. So the middle call is giving me a premium of 8 because the price expired at 60 only, so you will receive the entire premium 8. And if the price goes up, so this will give me a loss, this will give me a loss of 5, but it will give me a loss of 5, no, it will give me a loss of maximum to the premium I paid, that was 2. This will give me a loss of 2 only. So what will be my net around? So 1 gone and plus 8 and minus 2, so that means around 5. So this will be my profit, which will be the maximum profit if the market closes at 60. because lower call will give me a profit of 5, but it takes a premium of 6, so there is a minus 1. I'm selling 2 call for a premium of 4. So I'm selling 2 middle call at 4 1 each, so 8 rupees premium I'm gonna receive, and the upper call will give me a limited loss that is not more than 2, so the net profit will be 5. Okay, now just think what happens if the price goes up. Let's say price goes to 70. Okay, so spot goes to 80. Let's take it spot goes to 80. Now in that situation what will happen? Lower call will give me a profit. How much? Lower call will give me a profit of 25 minus 6. Okay, and at the same time this is around how much? 19. And the second one will give me a loss. It went to 80, so it give me a loss 20 into 40 loss. And also at the same time it gives me a premium also of 8. Okay, so it gives me a premium of 8, and at the same time the third one 65, it gives me a profit of 15, and it gives me a loss of how much? The premium gone is 2. Now what will be net? Somebody calculate and tell me. 0. Okay, so your maximum loss will be 0 wherever the market goes. If you want to take it to 100, you check it with 100, the same result will come out. And if price goes down, again same way, you have to check what will be your break even. It may be 0 or maybe near 1, and but your maximum profit is at 60 if the market expires at 60. So this is a good strategy. People apply it, butterfly. Then we have a strategy called a calendar spread. Okay, now what is a calendar spread basically? Now calendar spread is basically is creating by taking two calls or two puts of the same strike price. So you can create it by taking two calls or two puts of the same strike price, but of two different months. So which means that you have contracts like future contracts for 1 month, 2 months, and 3 months. Same wise, you have calls for 1 month, 2 months, and 3 months. And we know that if the call, if we take for a higher expiry period or longer maturity, we have more premium to pay. And if it is a shorter period, you have lesser premium to pay. So since you sell, you receive more premium for longer expiry. So what we do here is we try to create a calendar spread with two calls or maybe two puts. So what we do is this strategy is about it sells the short dated option, okay, and buys the long dated option. So it is call or put maybe. And what happens is the payoff is like butterfly. At one point you get great return, and after that you don't have uh, too much of losses. So you have losses are limited. Okay, so let's suppose we have two options buying the same strike price, 1 month call and second month call. Okay, the strike price for both is let's say 8,000, So what we are doing is 1 month we are selling, the short period we are selling, and long period we are buying. Now what happens is the premium paid here is, let's say, 100, and the premium paid here is, let's say, 200, or let's say 180. Okay. Now what happens after a month? Now what happens is the investors basically makes profit if the stocks remains in a narrow range or maybe at the same strike price. Okay, so in this case the losses are like, not flat. आप ये कह सकते हैं कि like in butterfly we have like this, the profits are, not perfect symmetrical that it will give you this much profit or log profit only. And what happens is losses also are not like butterfly. Losses could go like, uh, it can create like this. So on one side you have more loss, on another side you have lesser loss, kind of thing. So let's take example calculated what happens. Let's suppose the market remains at 8,000 only. It does not moves anywhere. So after 1 month one contract get expired, so you have a loss of 100 here, and this contract if you close, okay, so let's suppose if it moves, half of the time of the value money is gone, so that means half time value will remain after 1 month, because it's 2 month contract, so 1 month time value is gone, 1 month time value will remain here. So the premium could be around, let's say, 100 or 90. So let's say keep it 100. So this 100 you're gonna receive. So here you're selling, so you're receiving 100 as a premium here, and here if the market remains 8,000 and this time value reduces, if you buy you get it back, this 100, when you close your position. So receiving 100, so basically you are receiving how much? 200. Fine. And let's suppose if the price goes to above, let's say it goes high or low, let's say it goes to 8200, spot price goes to 8200. Now in this situation what will happen is the sell will give you a loss. So sell will give you a loss of 200, but you also received a premium of 100. It give you a payoff of 200, not loss, and you get premium of 100 also here. So this is into your pocket 100, and this call 8,000 will give you 200 intrinsic value because price went up, and the loss is like the time value is reduced here. Let's say 100 rupees gone, so 100 rupees remains same here. So my 200 will be again my profit. So my profit is almost locked. Okay, and it's not too much varying. Same wise, if the market goes down, in that situation it will give you losses. If that would be like the call you sold will give you unlimited loss, and the call you bought will give you limited. Sorry, I'm so sorry. I'm sorry. If the price goes down, the call you sold will give you limited profit, okay, of 100, and the call you actually bought will give you limited loss. So the loss will be, let's say, after a month maybe 100, so 100 remaining premium you will have, and this thing, if the price goes down, will give you also remaining profit. So that is around 100 rupees profit you're going to receive, that is 200. But actually up and down it's giving me profit only both the side. That in reality what happens is the premium we are deducing is 50% exactly here. So this is not the case in real life when we are trading. What happens is the next month call may reduce more time value as compared to 1 month call. So there is a little difference. But yes, it worked like a butterfly. And in one direction, you may have little profit because of the second month call going more or less with the time value of money. So basic strategy is you're buying at the same strike price. Okay, 2 month and 1 month. And if the price goes down, obviously sell call will give you profit and buy will give you a premium back. So after reducing the 1 month loss of premium, so 180 is 100 or maybe 90. So you receive that back. So that's what happens. Okay, so you have limited profit in either direction, up or down, and the losses chances are again very less. There are limited losses, very less, and that's because of the time value of money gap. Otherwise, it goes good. Okay, then we have straddles. Straddles are pretty easy, and then we have strangles. No, so straddles are like you buy and sell the call and put at the same strike price. Okay, so straddle, you're buying call and put at the same strike price. So you can say that the buy put and buy call at same exercise price. Okay, so now what happens is, let's say the premium is paid. Let's say if you're paying a premium of 5 here and you're paying a premium of 6 here, so this 11 is your cost. So let's suppose you're buying a put at 100 and you're also buying a call at 100, so same strike price. So if the market goes at 11 111, so this is your break even point, and if market goes 11 rupees down, so that means around another big break even point will be around 89. Beyond, after that, you will have profit. So your maximum loss is at 100. If the market closes at 100, then both the premiums are gone. The spot price closes at 100, both the premiums are gone. The 11 is gone. But one direction if moves, let's say goes up, the call will give you profit and put will give you limited loss. And the price goes down, put will give you unlimited profit and call will give you limited loss. So in that situation, in one direction, any direction it moves, you have profit. But if the move has to be more than 11. Okay, so this is straddle. Now, if you want to reduce the cost, so you can go for a strangle. Now, this will reduce the cost of premium. Now, in this thing, what we do is we take little out of the money call and put. So, what we do here is we buy, let's say, put, uh, we buy put, let's say spot is 100 and we are buying out of the money put. So, which means we are selling at a little cheaper price, let's say 80. It's too far, let's say 95, and I'm buying a call out of the money that is 105. Now in this situation, if out of the money I have to pay, let's say as premium as 2 here and premium as 1 here, so my cost of premium will be less. In that situation, when will be my profit? If price goes, let's say 3 rupees down from 95, or it goes above 8 rupees, more than 8 rupees, that means 105 plus 3 rupees, that is your cost. The break even will be that. It goes more than 108, that will be your, after that it will be your profit. And your loss will be into a big range. So 100 and from 95 to 105, wherever the market closes, okay, you will have a loss of 3. Around. If it is closes in between, somewhere. Fine? So this is your straddle and strangle. Now, let's take out about the strips and straps. So what is a strip? In a strip involves purchasing two. So what you do is you buy two put option, and at the same time, what do you buy is one call. So buy one call, and both at same strike price. So this is strip. And we talk about strap. Okay, in strap, what we do is we buy two calls and we buy one put at same strike price. Now what will happen is, in a strip, let's suppose price goes down, we have two puts and we have one call. So the put will give me profit, okay, and call will exhaust after some time because call have limited loss. And if price goes up, both put will exhaust after some time and call will give me unlimited profit. So in both the direction we have profit, but in one direction I have more, one direction I have less. And here in straps, if price goes up, we have double profit, and price goes down, we have single profit. Okay, but the investment is more here because we are buying three calls. So the investment, the premium we are paying is for three calls. So this is too costly as a strategy. Okay, then we have a strategy called collar. Now in collar, what we do is, it's simple. Collar is the combination of a protective put and a covered call. So you have to take a covered call as well as a protective put and then calculate the payoff of both. So you know what is covered call? Covered call is you buy shares and sell stocks, and protective put is what? You are buying stocks and buying puts. So you to take the both the things at the same time on the same stock, then it will give you a collar. Okay. And now there's one small concept about interest rate caps and interest rate floor. Now what is interest rate cap and what is interest rate floor? Very simple. That is more or less related to FRA, forward rate agreements, which you're gonna read, and Rajat gonna teach you for that maybe in next class, upcoming classes. So interest rate cap is basically, these are kind of options contract on FRA. So let's say the LIBOR rate is currently 5%, and we set a cap at 6% above, 1% above. So we said the strike price is 6%. If the market is above 6%, then we give you the profit. And if we set a lower rate, let's say 4%. So current market is price is 5%, and we take a strike price of 4%. So after 4%, if the price goes down, okay, then we have the profit. So this is a floor price. So understand this cap and floor, you have to understand the forward rate agreement, which is into another aim statement. We'll cover that later on. Now what's the time now? Now it's 11:30. We will wind up. Okay, and In next class, we'll be doing, let's say this Rajat will be taking your classes. He'll be taking interest rate futures, swaps, okay, and something more, maybe. So my two topics are left. One is exotic option, which is purely theoretical. I'll send you a note on these exotic options. You have to go for a self-study. There's nothing great to explain. So simply read the note and exotic options are over. And then we have properties of stock option. This I gonna do it on some Saturday. So I have sent you a schedule. Okay, so we will fit it into one Saturday. So property of stock option, my topic is left one, and I got give you a prior information of that. And